one of the challenges I find is determining what is a mistake and what is intentional, right? So if they know that there's super high debt levels and the only way to discharge them is through inflation, you could make an argument that it was a mistake. Whereas so it's kind of like, are they smart but then being misleading, or are they actually dumb, right? So it's kind of like one or the other. There was a BlackRock paper written in 2019 before the pandemic, and it was like, the next downturn, monetary policy is not going to be enough because interest rates are so low and debts are so high. So we're going to have to do significant fiscal stimulus, but that can be inflationary and drive rates up. So they're going to have to keep rates low through monetary policy. So you're going to have coordination between fiscal and monetary policy. But then the challenge is that that can cause runaway inflation. So that's going to be managed very carefully. So they actually kind of laid out the whole playbook ahead of time. And that was both BlackRock, and it was advised by Stanley Fischer, former Fed official. And of course, they didn't predict a pandemic, but so it's kind of even bigger than that paper would have suggested. But we actually followed that playbook almost step by step in terms of watching what these policymakers are doing. And so, I think that they certainly overdid it. I think even in their view, I think part of the original one, they wanted to let it run hot for my first reason, that they wanted to burn some debt away. But I didn't think that they thought it would get this hot this quickly. And I think if they did, they probably would have done certain things differently. And I think it's because a lot of their models are just not great. I don't think they're looking at oil capex, the real world supply side stuff. And I also don't think they're making a great distinction between broad money supply and base money supply as its impact on inflation. I just think that a lot of their models are out of date, and that the models are kind of bureaucratic. I mean, they're these large institutions, a lot of academic input, and I don't think they have like the rapid learning effect that you see more in like the business world. I think these external things eventually change their plan, especially as expressed through markets. And so the Fed has to kind of put out fires as they come. And so these events kind of, end up showing up in markets, which then ends up having to be the things that the Fed has to respond to. So, for example, in 2019, I bet none of them expected what they'd be doing in 2020 at the scale they were doing it at. And so they had to, I mean, they had an emergency meeting in March 2020, and they were kind of changing their plan because the treasury market broke, which I don't think was on like, their 2019 bingo cards. Um, things like what we're seeing geopolitically, it's challenging because it's like it becomes self-referential. Usually, um, the problems are like when you have long-term debt cycles blowing up and then you have more inflationary periods, that leads to more discontent and more geopolitical struggle, which then leads to more inflation. And so it's kind of that vicious cycle. That's generally what you see in these periods. And so one leads to the other and one leads back to itself. And when it comes to, for example, what we're seeing in say, Ukraine, Europe's energy prices, so natural gas prices in Europe, which if anyone has looked at them, they look like a Weimar chart. It's like it's a horrifying price chart, compared to what we're experiencing in the United States in terms of energy prices. So no, natural gas prices soared, but that happened in late 2021. They were already encountering challenges with that, and then the whole Russian invasion just added more problems on top of that. It didn't create the problem initially; it just added layers of additional risks and insecurity and additional volatility and inflation on top of what was already, a physical constraint in terms of natural gas and other things that were happening there. And so I think that's going to be the theme of the 2020s is basically problems feeding back on making the problems even worse. I look at what the public models are doing. So I look at what official CPI is doing because, of course, that's a lot of traditional markets like the bond market will look at things like that. So they're relevant to know and to understand what's happening in that data. But then I also do go out to things like these real-time rent indicators and things like that. And it's a couple of things. One is it helps you determine the accuracy or the inaccuracy of things like CPI. Two is it lets you predict what's going to happen with CPI. So one of the reasons I was expecting CPI to go up is because I saw the rent component happening in real time, and I was like, this is going to start showing up in CPI because CPI kind of incorporates that over time, but like with a lag and smoothed out and somewhat inaccurate, but it still ends up getting into there in a pretty significant way. And so I think that looking at that mix of things is super important because the government statistics are important for traditional markets responding to them, and knowing how policymakers are going to try to respond to them and how they're going to signal around that. But then, yeah, those real world faster time updating ones are super useful for accuracy. There's also things like there's services that track what used car prices are doing. It comes out, every couple weeks instead of, with a lag, and it's, in my view, pretty accurate. And like you said, there's really good rent indicators, things like that. So I think they could be effective in the near term, and I think to some extent they've already have been. They contributed to the housing market seizing up, for example. If you make financing costs a lot higher, that does impact companies' ability to get capital, consumers' ability to get capital, to borrow things to buy assets and to buy other things. And there's also like a wealth effect, right? So going into this period, U.S. household net worth was 6 times as high as GDP. Um, it got up to 4.5 during the dot-com bubble. It got about the same height during the 2007 housing bubble, but going into this period, it was six. It was 6 times. And so when the Fed is able to put downward pressure on asset prices by doing things like ending QE, doing some mild QT, trying to raise rates to a period of time. And if people see their asset prices going down pretty quickly, that can also change their discretionary spending levels. And so I think a lot of these things combined do impact demand in the near term. But the problem is that because the economy is so financialized, because there's so much debt in the system, and because the supply side is not really being fixed, especially if you look at the energy component of that specifically, it's kind of short-sighted in the longer term. That basically the only way out of this is improving the supply side. Um, and so again, if you go back to, does the Fed not know, or do they know but they're signaling differently? And so if they're fighting this like the 1970s, I think that's an error. I think instead they have to be aware that in many ways it's more like the 1940s. And so 1970s attempts are likely to backfire and just lead to more pain ahead. I think it's going to be I think we're going to have this inflation issue. I think is going to be something that reoccurs for a period of time. I think that they can cause a recession, and then you start to get problems in, say, the treasury market or things like that, and then they have to reverse course, and then it damages their credibility, and then they basically, ironically, by tightening, they can impact the supply side. They can make it hard to bring on new supplies of things that are short and contributing to inflation, and then therefore they can lead to even another inflation spike when they eventually have to reverse and turn dovish again. I think the problem itself goes back to the root of price controls. I don't think that they should be doing price controls. And if you ask most people, should they be doing price controls, and people would say no. But that's essentially what the purpose of a central bank is. They do price controls on the price of money, and so you're kind of in a period of perpetual price controls. And so, of course, the question is, if they set the price at the wrong level, either too high or too low, that has huge ramifications. And so I think the deeper question is kind of like, should central banking in its current form even exist? But the nearer term problem, I think, is that as you get to the end of a long-term debt cycle, so as you get to lower interest rates and higher debt as a percentage of GDP and higher asset valuations as a percentage of GDP, you've really financialized the economy, and then there's no clean way out, right? So I often ascribe, the problems that they have now are somewhat less about what they're doing right now, right? So I'm blaming Powell for all this inflation. It's decades of kind of policy compounding, and then here it becomes a series of bad decisions, right? Are you going to choose one bad outcome, or are you going to choose another bad outcome because they've already kind of painted themselves into a policy corner?